Okay, the fourth and final financial statement of the sole proprietorship is the statement of cash flow. The statement of cash flow has the following information: sources of cash, the ways cash changed during a designated period, cash received from revenues and other transactions, and cash paid for expenses and other acquisitions. Or acquisitions is just a fancy word for things we acquired. So whether it was property, inventory, whatever, things that we paid for during the period. The information about cash activity of the enterprise is considered to be an important signal to investors and creditors about the prospects of future cash flow. So by recording our cash flow, it kind of helps to predict what they can expect in the future with this business. So calculating a cash flow statement, I'm not going to go into a lot of detail just because we don't have to prepare one of these ourselves, but just looking at some of your calculations here. So the format of a cash flow statement is given by net cash provided. So you'll see in this first section, cash flow from operating activities, cash received from revenue, cash paid for expenses. So net cash provided by operating activities. So these are our operating activities, our sales versus our expenses. And so we received $22,000 in revenue minus $14,000 in expenses. So you'll see if you see a number in parentheses, that means we are subtracting that number out. And which gives us net cash provided by operating activities, $8,000. So something I want you to notice, same thing in this statement as the others. We add the numbers in the left column, and then we put the totals in the right column. So like in this next section, cash flows from investing activities. So we purchased some land, building, tools, and then we sold some of that investment. So they are calculating the numbers on the left and recording the total on the right. Cash flow from financing activities, sale of capital stock. And again, don't worry about this cash flow statement. This is something we look more at in accounting 2. But this just wants to give you an idea. This is the fourth financial statement of the sole proprietorship. So they just wanted you to be familiar with how that looks. The last few topics in this section includes profitable ratio analysis. So this ratio analysis is finding the relation between two variables taken from the financial statement. What? Okay, so basically there's different ways to determine the relationship between two different numbers. So the relationship between operating results as reported in the income statement, resources available to the business as reported in the financial statements. Let's just kind of look at what these ratios look like. So for instance, this one is a profitability ratio. So a profitability ratio is return on sales. So after we sell our items, what is actually turning into net income? Because remember, if we have our sales revenue and then we have to subtract out all of our expenses to find our net income. So we want to find the relationship between sales dollars and actual profit or net income. So this profitability ratio looks like this: net income divided by sales. So let's look at this example. Calculate the profitability ratio when net income in the year is $40,000 and sales total $100,000. So we put net income over sales, which is $40,000 over $100,000. If we divide that out, we get 0.04, and we want to turn that into a percentage. So 40% of our sales gets turned into net income. So that's a good estimate to kind of just give your business when you're looking at, okay, we're averaging about 40% of every item we sell goes directly towards net income once we subtract out expenses and all that other jazz. Another example, part 2, calculate the profitability ratio for the next year. So this is a look at net income and sales of the next year. And again, net income over sales gives you 50%. So they increased their profit per sales dollar by 10% in the next year. So I will help you with remembering these different ratios. But again, you're just finding the relationship between two different numbers, and this profitability ratio looks at net income over sales. When we refer to the liquidity of an asset, it's the ability to which an asset can be changed into cash. So how easily or how liquid is that item that can be converted over to cash? So this measures the short-term solvency of the business, or its ability to meet its short-term financial debt. So what cash do we have available, or what assets do we have that we could change into cash in order to cover our short-term debts? So we want to take into consideration these. We need to figure out our current assets, current liabilities, in order to find the firm's current position. So current assets, and then there's different kind of definitions for each of these. So current assets are those assets which can be converted into cash within a maximum period of 1 year. Okay, so current assets would be cash in bank, because that's already cash, so we know we can get that into cash within a year. Our cash balance, cash in bank, accounts receivable is money that people owe us, and then also the stock of our business. So those are, again, assets that can be converted into cash within the maximum of a year. Those are current assets. Current liabilities are the debts which are to be paid within a year or during the normal operating cycle of the business. This would be any creditors that we owe, accounts payable, outstanding expenses that we still owe on within that year. Those would be current liabilities. Working capital then is the difference between current assets and current liabilities. So when we're calculating our working capital, we need to look at our total current assets and our total current liabilities. So the total of what we own and the total of what we owe. And that would give us our working capital. So total of what we own would be $1,000. Total of what we owe, subtract that out. So our working capital is $300. So that's the value that we own right now, because we still owe $700. Okay? Current rate, so that was working capital. Current ratio, and I know these are a lot of different equations I'm throwing at you. I will get you a reference guide together to kind of help with organizing all of this. The current ratio is the relationship between current assets and current liabilities. So we look at assets over liabilities. That gives us our current ratio. So our assets in this situation are $2,000 worth. Our liabilities are $500 worth. The current ratio then is 2,000 over 500, and we turn that into a ratio number, so it'd be 4 to 1. 500 goes into 2,000 4 times, so that's where we get our 4, and then 500 into itself once, 4 to 1. And this kind of explains the purpose of the ratio. So a ratio of 2 to 1 is considered to be an ideal ratio. It indicates that the business is able to pay its current debts and has 2 times the current assets over current liabilities. So in this example up here, we had 4 times the assets of our liabilities. A low ratio indicates that a company may find it difficult to pay its current debt. So if our ratio is any lower than 2 to 1, that would mean we don't have enough assets to, or it's going to be difficult for us to gather enough assets to pay off our current debt. And then finally, we have a quick ratio, which is the relationship between total quick assets to total current liabilities. Quick assets contain the following: cash, marketable securities, and accounts receivable. The quick ratio is calculated by dividing the total cash and receivables by current liabilities. So we have our quick assets, which is these 3 things up here, over current liabilities. So for example, cash is 2,000, accounts receivable is 6,000, over liabilities, 8,000 over 3,000, which equals 2.66 to 1. The ideal quick ratio is 1 to 1. It indicates that for every single current liability, the business has 1 quick asset. The higher the ratio, the greater the ability to pay current debts. I know this is a lot of information and equations that we just threw at you, but don't worry, we will be going over this together and clear up any questions for you in the Class Connect session. Okay, and then on the page 23, we have some terms that we use throughout this section. Make sure you are familiar with those, and that covers section 6.